Hey everyone, it's Robert Keens with goldsilverpros.com. It is Thursday, August 13th, 2020. We've had a little bit of a recovery in gold and silver, so I wanted to get into that. Go ahead and share screen and we'll take a look at what's going on in gold. I have this as the 1 month gold chart, and you can see starting on the 6th, we had a retraction in the gold price down to about the 1914, 1950 range. And the last couple of days, we've come back up to about 1970. So it's a nice little mini recovery in gold. Nice to see that happen. If you recall, about 2 weeks ago, maybe going on almost 3 weeks ago, I said that we were due for a correction in gold and silver. I didn't think there would be major corrections, but there would be corrections nonetheless on our way up in these bull markets. That did occur. And then Tuesday this week, I said it's more than likely, based upon the data we're seeing on COMEX, that those prices would start to recover somewhat. I thought we were still in the middle of the bull market. For gold specifically, I said, it's unlikely that gold will pull back to the 1800, 1900 level. It's possible, but I didn't see it coming back all that way, and it doesn't look like we're going to get that much of a dip. But let's explore gold just a little bit more. We're going to blow this out to my 12-year chart here again. And I've revamped my charts. If you see here, I've redrawn my lines to be a little bit clearer than the charts we were using before. And you can see that gold had surpassed its all-time high right around $1,900 and had come up to above 2050, and now it's retraced down about $80, $90 to the 1970 range. That's really not a very big correction, to be honest with you, looking at this move, dating back to about here when gold price started to rise in October of late 16. And that's a little bit of a retracement. That's nothing to be alarmed about. If we were to do the cup and handle formation that I've been talking about over and over again, not saying we'll have one, but if we were to do one, it would probably come back down into this range, maybe around 1655, which is the 200-day moving average, or 1700, somewhere in that range. I don't see that happening, and I don't think this correction is going to last that long due to what we're seeing on the exchanges, but it's always something that we'll look for. But so far, patterns are holding steady in gold and silver, so I expect that we'll continue to march up. I wanted to review the open interest with you on gold to talk about one of the reasons we might have had the correction. So I'll actually go back to the 1 month chart on gold so we can see the date we started to have correction. Right around here on the 6th of August is when we started to have the correction. This is a chart I hadn't shown you yet, but it has to do with overall gold volume. This is basically open interest. It's another way to view it. The traditional open interest chart I've been giving you is basically almost a spreadsheet format or a tabular format. Didn't have this nice visual on it because it packed a lot of data in one place. This chart's actually probably a little more friendly for you guys who are just getting into this and wanting to learn. But remember that December 20th contract in which I said there's a ton of open interest? That's really where the price is determined. If we're looking at how the spot price is determined, you take the nearest month with the largest volume, and that would be December, and that's what determines the spot price moving forward. And as people battle for that contract going long and short, that determines the spot price. So it's not just the month we're in, but it's also the month within the next couple of months or so that has the most volume. I know that can be kind of confusing, but just remember, look out 60 to 90 days. And if you see this massive increase in open interest, that's probably pulling on the price quite a bit. And the reason that is the case is because we're dealing with futures markets. Futures markets or futures bet on what gold will be worth sets the current spot price. And as long as that future is trading within a couple of months of today, that can influence and pull up or pull down the spot price. In addition to that, what's going on with that futures trade on a day-by-day basis can pull up or push down the price of any commodity, including gold and silver. So again, we'll go back to the 6th of August. We saw this start to come down all the way through the 11th, and it's recovered the last 2 days. Well, as you can see on the 6th, the volume started to increase through the 11th. And this volume is the battle that's going on in gold and silver. I'm going to blow this back out to the 12-year chart real quick. And remember the video I showed you on the battle and the volume. This volume you see here is the same volume over a longer time frame that you see here. This is more of like a month view. This is more of like a multi-year view. So this volume here is the same as this volume here. But this volume will tell you more on a day-to-day basis what's going on with gold. And you can see that as the volume increases during that time frame, and again, sorry, having to go back to that 1 month chart. As the volume increased over this time frame, the price came down. That meant there were more shorts than longs. Okay. Remember, when more shorts come in, it pushes the price down. When more longs come in, it pushes the price up in the open interest. In the open interest, I'll explain this again for those of you who are new to my channel. Open interest is just the total amount of interest in the futures contract, both long and short. And that can be just basically the paper interest, if you will. The COMEX is a market that's traded mostly on paper, and it's settled mostly in cash, or participants will roll their contracts. So they may have a certain amount of long contracts. They'll just roll them to the next month, roll them to the next month. Or if they want to settle out of their position, they'll settle for cash, and either they'll pay cash or receive cash, depending on if they won or lost that bet on the futures market. But the overall amount of trades is called open interest. The second factor we look at are the delivery reports. So let's go look at the delivery report for gold. For those of you viewing this for the first time, this is month-to-date delivery notices from the COMEX. And we're looking at basically yesterday's data. Even though it's close of market, this data won't be updated for the 13th, which is today, until tomorrow. So we're always looking a day back on these metal delivery reports. These metal delivery reports you see here for gold, this cumulative number of 48,004 contracts so far through the 12th of the month. These are where the longs are wanting to take physical delivery of the gold. So a moment ago, I just mentioned that the open interest is the total amount of longs and shorts on the market. That's long and short bets total. That could be the paper bets. Okay, the speculative bets, a certain portion of those longs will want delivery of the metal, and the shorts will have to deliver, and that's the delivery report. As you get a higher percentage every month of more delivery notices, that means more longs are pushing for the actual metal. That pushes the price up. It's like an amplifier to the longs position. They're not just settling for cash and gambling. They actually want the metal. That pushes the gold price up. So we saw the first intent day of the month, which is when you can first notice that you want to get delivery for your long position. There were an astounding 32,732 contracts, and then that sort of fell down, and the gold price came with it. So if we look at the pullback from the 6th through the 11th, we saw that there was a little bit less volume the 6th through the 11th in terms of these contracts on a daily basis. Now on the 10th and 11th, it spiked up a little bit, and that kind of gave a little bit of increase in the gold price. So it's not a one for one. There's a little bit of lag time between when the delivery notice is put in, that gold price comes up, but there is a correlation. And really what you want to do is look at it over time. That's why I always look at the monthly report. We're still sitting at 48,000. That's a large number. And so the gold price, I would say, would continue to be bullish. Now, in a future video, I'm going to talk a little bit more about how this all works on the COMEX. I've kind of hinted at this in past videos when we're looking at actual gold transfers between accounts at COMEX, how that affects the gold price. But there's a little bit more detail to that. I'll get in a future video. I'll probably do that for Sunday. So stay tuned for that. We'll get more into those details. But for now, just know that when you have somebody actually wanting physical delivery, and the percentage of the longs in the market want physical delivery, it's very bullish on the price. So as long as we see these numbers adding up throughout the month and being strong and continue to be strong month to month, we just should expect a strong gold and a strong silver price. So now I wanted to get into silver. We had a pullback in silver as well, about the same time frame, although it started a day or so later. It was a sharper pullback from a percentage perspective, which is normal in silver. Silver is more volatile, meaning there will be higher ups and downs than there will be in gold. And that's normal for silver. It's basically always been the case since the futures market has been in effect. Silver is a much smaller market. It has multiple components of demand. It has industrial demand for use in our industry, as well as monetary demand. So it tends to move more violently when it moves than gold does. And so gold is kind of like the turtle, and silver is kind of like the hare. The silver moves faster or more violently. Gold moves more slowly, but eventually gets to where it wants to go. So as we can see in silver, you saw us kind of come up against this $26.5 resistance line. It stayed up there for a while, came back down and retested it, which is bullish, by the way. If you come down below a line and you come back up a second time, so here's the first time we crossed 2650, and here's the second time, that's bullish over the long run. It means that there's enough interest for traders to psychologically break through that barrier. So what is this resistance line that I'm talking about? If you're new to the channel, you may want to understand what this means. What we do is we plot these resistance and support lines on the graph. I just draw these straight lines across a price chart. And we do that because these charts are very psychological. Traders are psychological. They'll trade around certain numbers, like even numbers. 5, 10, 15, 25, 30, stuff like that. But they'll also trade around previous trading patterns. So where we've had a previous top or a previous trough on the market, especially if we're in a massive bull or in a massive deflationary move like we had in the 2009 2011 timeframe, and then after through about 2014 when it came back down, these are very important psychological points, and they will set in traders' minds the next stops or resistance point for the next bull market. And so that's why I plotted all these lines. You see that we didn't pass the $30 psychological line in silver. Again, $30 a multiple of 5. So a lot of traders are going to look at that and say, I'm not sure if we want to, pass 30. We didn't do it on the first try. So that means we're probably not ready to break through 30 just yet. There needs to be a little bit more momentum built in silver. And in silver, there is a ton of open interest coming in the upcoming month in September. And we'll get to that in just a moment, where that could be decision time where it pushes silver firmly above 30 and into the $32 to $34 range. But for now, silver came down and almost tested this 2450, which is a very important point that we broke through about 2 weeks ago when I did a video. And it didn't quite get to 30, and it came back down to 26. So you can see it sitting in between 30 and 24. That's a range trade. And it wouldn't surprise me if silver range trades a little bit there for a while until we see what's going to happen in September with physical delivery. So let's go look at the 1 month chart on a silver real quick. And as I was saying, that's about 2 weeks ago, July 23rd, 24th, we tested this 2450 resistance line. We didn't quite break through. We tested again. This time we launched not only through that resistance line, but the next one. When you see it bump twice and it goes through, that tells you it's a strong bull market. But after it passes one of these resistance lines, these become support lines, and it's almost invariably going to come back down and test support. This is a normal bull market. It'll test support, and if it comes back up through support a second time, here once, here twice, that means it's probably going to continue through. These are just basic chart patterns. They're basic psychological patterns. As people get comfortable about a commodity trading above or below resistance line and having staying power, they'll come back in. It's just normal. It's just the way that we look at the markets. So I expect silver to continue to move forward. We're going to go over here and take a look at silver's data. Again, this is open interest. We'll look at deliveries here in a moment, physical deliveries. September, I said in the last video, was decision month because there's so much open interest. Look at this compared to all the other months. Tons of open interest. These numbers are very big. So that's where the longs and shorts are going to be battling. And that's where the price is being determined right now. It's not in the August contract because it's extremely low volume. It's September. It's the futures bidding in September that's determining the price now. Now, I wanted to make a point here about silver. Silver's, as I said before, if you remember, silver's more volatile. That means when people come into the futures market and they put a big bid either way, silver moves more as a percentage than gold does because it's a smaller market. And it has multiple demand factors, not only monetary, but also industrial. So it's got a lot of stuff going on. Well, look at the pullback in silver, which occurred on about the 10th of August and lasted for a couple of days, and then before it started to come back up. Look at this date here, and then look at the increase in open interest, which started the 7th, the 10th, the 11th. So basically, as the open interest increased, the price decreased, okay? As the open interest increased, as it increased, the price decreased. That means there were more shorts than there were longs. Remember, open interest is a measure of both shorts and longs. Now, they don't break it down in this chart, but you can essentially tell from the price movement and more shorts are coming in and more longs are coming in. So what happened was silver's trading at this, let's go back out to the 12-year chart. We'll update that here real quick. So silver's had this massive bull run since about April. I mean, it traded about $11 March, April when we first had the economic situation. And then as we kind of figured out what was going to happen in the economy, there a lot of monetary demand came in for silver. That's what caused silver to move very quickly. Monetary demand will cause it to move very quickly. It's additional demand that we don't typically see when silver is just trading only as a commodity during normal non-recessionary times. Get recessionary times, people come in to bid up silver as a monetary asset or a safe haven asset, much like gold. So we saw that rather sharp, rather quick move straight up. Well, one, from a technical perspective, it has to pull back a little bit. But two, there were a lot of shorts that came in and just pounded the silver market so that it came back down. Okay, that's people taking bets that silver's price is going to come down. And by issuing that many short contracts, it's going to cause silver to come back down. So what will happen to all of those shorts? Well, it depends on actual deliveries. Deliveries is where you're going to see the pain. So we're going to go down here to, again, this is the month-to-date delivery notice. We're going to go down to the silver section. And as we see here, there's a fair amount of interest building on silver contracts. Now, this is for 5,000 silver futures. On gold, it's 100 ounces. On silver, being the cheaper asset, it's 5,000 ounces. So you're going to see smaller numbers here, but it's multiplied by 5,000. There is a fair amount of people standing for delivery for silver on the COMEX. And again, not nearly as much as last month. So last month in July, we saw a lot. That's why I started this series in July on the 14th on my channel with silver, because we saw so much demand. It was something like 14,000 contracts standing for delivery. And I think it even went above that by the end of the month. But that was by the middle of the month, 14,000. That was just a huge amount. Now in this month, it's kind of cooled off a little bit. We only have about 1267 cumulative. So that's only about not even a tenth of what we had last month. Of course, we still have a couple of weeks left, but it looks like the physical demand for silver has died down since last month. That's another reason in which you see the silver rally start to fade a little bit. Less physical demand on the COMEX, and the shorts coming in and placing a bunch of paper contracts, almost daring the longs to take delivery with those contracts and make them pay for it. And again, that's going to happen in September. In September, we're going to find out really quickly. Whether this overwhelming amount of open interest, longs and shorts, who's going to win that battle in September. If the longs win the battle, what I expect to see come that time is for September, for us to see a massive amount of people standing for delivery. That will be our key. And so a lot of people have asked on the channel, Rob, how do we know when that's going to occur? Is there a specific date in which we know for the September open interest, whether it's going to be a bull or a bear? So we're going to pull back sharply, the short's going to win, or the long's going to come in and demand that middle and really make them pay. Well, if you remember a couple of videos back, I think last week I started talking about delivering intent notices. Intent notices are the notice, if you're a long, that you want to take delivery of the silver, the gold, the wheat, the whatever commodity it is. It's the same for all commodities. That intent date is 2 days before the first trading day of a month. So 2 days before the first trading day of September is when we're going to see the first notice. So within the first few days of that September trading month, actually the very end of August, we're going to get a clue as to how many deliveries, how many longs are standing for delivery. If we start the month off really weak in the delivery space, that may not be too good for silver. It may mean that silver may be coming down, or it may range trade here on the chart. It may mean that demand is weakening. And we really aren't going to know. We can make all sorts of prognostications based upon this data or that data, but we really have to watch the markets to understand what's going to happen. But as we get closer to the end of August, I'm going to come in and do some videos for you guys, and we're going to watch this delivery data. Okay, we're going to watch two data. We're going to watch the open interest data and see if this open interest spikes again. If it spikes again, that means somebody's coming in the market, whether long or short. Is it long or short? Well, that you tell how committed the longs are by how much they're standing for actual delivery. And that will tell you how committed the longs are versus how committed the shorts are. If we see relatively anemic numbers, like only 12 or 1,300 contracts, I don't know, it may not be a continuation of the silver bull market. We may come back down a little bit and correct for a while. But I have a feeling longs are going to come in big time, because silver really is undervalued, most people think, compared to its past history, compared to its value, compared to its use. Given all the fundamental issues we have in the economy, so on and so forth, many people think the monetary demand for silver is only going to increase. And so all this open interest will end up being mostly long. But if these big bullion banks come in with their clients wanting to bid short on silver, we could see the opposite. We don't know. But September is the battleground for silver based upon the volume. We're going to find this out. The next month would be December, but September, by far, magnitudes of order, almost 10 times more open interest than there is for December. Now for gold, that is, if we go back, that battleground month, remember, is December. So we're going to cover silver a little bit more closely for the next few weeks, and then we'll get into gold, and we'll kind of see where gold is going to go. But that means, and this is normal in between these two precious metals, silver is going to move more violently. Gold may follow that, or it may not, but it's going to move a little bit more slowly. It's going to take a little bit more time to build up to that. So guys, we will definitely cover that for you guys as we move forward. And real quickly, I wanted to look at the depository statistics. So we're going to start off with gold. And this is just the Commodity Exchange Metal Depository Statistics Report. This one's for gold, so we'll highlight that in a goldish color for you guys. And then I've got one for silver too on another spreadsheet. This is produced daily. So this report data is from yesterday. Again, they haven't published the 13 for today yet. It's a little bit too early. We'll get that probably early in the morning. But it shows the overall amount of gold sitting on depositories. There's something I wanted to clear up, and so it's not confusing for you guys. When we look at which depository this is a depository for the COMEX. So COMEX doesn't have one vault. It has basically sub-custodians that are recognized names in the field and have been approved to store on behalf of COMEX, which is more of the market itself. The COMEX is this quote unquote market. But there are participants, these guys in bold here, Delaware Depository, HSBC, Brinks, that are the people that store the metal. So these depositories obviously have a bunch of different customers. So when I say Brinks has so much registered and eligible gold or silver, I'm not saying that Brinks is the company actually trading that for their own book. They could have some in their own book, or a lot of it could be their customer demand. The way that the information is produced, it doesn't break all that down for you. We don't get to see on a transactional level every transaction that goes on. So we're never going to know who's actually who's actually wanting to store gold at these depositories and who's wanting to accumulate gold. We can only look at this at a bulk level. That's one of the issues of using COMEX data, is we can't get to the transactional level. But COMEX is actually more transparent than the other metals markets, so we look more at the COMEX. That last sentence that I just stated will be the subject of a future video. I'm doing research on the LBMA and the Shanghai. When I'm done with that, I'm going to bring that to you guys. Not quite ready to do that yet. So right now, we're just going to talk about the net activity for August 12, 2020, which was yesterday, for gold on the metal depository within these different depository participants. So Brinks tends to get a lot of action, as we've been following this the last month. So they have added 129,536 gold ounces to their registered category. They lost 32,106 from eligible, leaving them a net of 97,431. Just to go back and reiterate, registered is that gold or silver or wheat or whatever that's available for delivery against futures contracts. So that's the number we pay the most attention to. That's where it could get delivery for the long standing for delivery. The other number, the eligible, really is just storage. That eligible doesn't necessarily, it can't in that category be used for delivery, and it doesn't necessarily have to roll up to register. There's no one-for-one relationship there. This eligible could just be storage that customers want in there. And as you can see, there were 32,000 ounces taken out of Brinks today. So somebody was taking that gold out. Does that mean that it was somebody that had received that gold as a pledge for a contract that delivered in the previous month from Brinks and they took it out of eligible? We don't know, because there's not that level of transparency. We're looking at the aggregate level. All we know is net today, Brinks lost 32,106 out of their eligible category. For what specific transactions, we don't know. And they gained 129 for a net increase of 97. We saw a little bit HSBC, only 16,000 came out eligible, no change in their registered up here. A big one overall, it basically was Brinks. So a total, if we look at combined total, COMEX added, the various vault sub-custodians added 81,270 ounces. 48,000 came out of eligible and 129,000 came into registered. What this tells me is today, people increased 130,000 ounces for registered, meaning they may deliver them against future contracts. Maybe that's in preparation for December. We don't know. That's the big month in gold. But that's basically what's going on here. So now I'm going to look at the silver edition. So this is silver, so we'll give that a little bit of a silver background color for you guys. And this is, again, is a report for August 12th. And we saw a lot of activity here. You can see a lot of highlighting going on. CNT Depository, its total client base, of which we don't know who they all are, we don't have that transactional data, at least in detail, lost 242 offer registered. Maybe they, that was delivery against a long futures contract. They lost 1.5 million silver ounces against eligible, which means somebody pulled it out of regular storage, but not necessarily having to do with a futures contract. We saw about 16,000 come out of eligible for Delaware. We saw 83,000 come out for HSBC. We saw 1.194 million come in to JP Morgan Chase to eligible. So again, not against a futures contract, but overall boost their overall amount of silver that's stored for JPM clients at their approved COMEX depository. About 200,000 for Malka. And overall, there was about 239,000 ounces pulled off for silver, pulled off of the net COMEX depositories. Okay, so we've had a lot of interest in past months, people standing for delivery of silver. Now we're starting to see some numbers come off. So that means that people are pulling it off. Most of it, however, was eligible. So that doesn't have to necessarily mean it was for futures contracts. Could have been for other things. Could have been transferring to another exchange. It could have been, overseas. More than likely, it's just people taking their silver out for safekeeping. Maybe they're using it. Maybe it's a manufacturer storing it there and they're using it in their manufacturing process. Again, we don't know, but we're starting to see now a little bit come off, and that's a positive sign that some drain is going on. There's one more thing I wanted to say about these depository statistics to clear up something or to add a little color to something I've talked about in previous videos. This is going to take just a moment to explain this. I've said before that when people are standing for delivery and they're taking gold or silver out of registered, which we see in these depository statistics. Let's go back to these depository statistics. And we'll go up to gold since it's the bigger number for now. When we see people standing for delivery to the effect of 48,004 contracts of 100-ounce gold, which would basically be about 4.8 million ounces, it doesn't mean that it actually comes out of COMEX. It just means it's transferring hands. So let's say you're JP Morgan and you have a client base. Some of that client base is going long, some is going short. Net, you're going to give up so many thousand ounces of gold in a month. Well, that gold could actually stay on the COMEX. It could just simply change hands from one COMEX participant to another. And it may go from a registered account to an eligible account, meaning that person's going to take it and they're not going to put it for registered, or maybe they need it for registered on their overall contracts. Maybe HSBC needs it because they're delivering gold against a long contract, so they're going to put it in registered. These are all aggregate numbers, and it's hard to trace exactly what's going on. We just have to look at the nets. But at the end of the day, just because there are long staying for delivery, whether gold or silver, doesn't mean it actually comes out of COMEX. It could go to some other participant in COMEX, and they could choose to leave it on the COMEX. Okay, so when going back to the discussion of force majeure that we've had before, and going back to the discussion of standing for delivery and taking out of COMEX, so far, I mean, we're still sitting at 36 million ounces, and that's the same as it was a month ago, basically, without a whole lot of change in terms of gold. So a lot hasn't come off of COMEX. That means it's basically changing hands on the COMEX. Now, it still does drive the price up. It still does drive the price of gold and silver both up as we look at the charts. Let me back out to a 12-year chart. We're going to update this. All this standing for delivery is bullish. Why is it bullish? Because this market is longs and shorts, future bets. And when more people stand for delivery than not as a percentage of the total amount of bets, or what we call open interest, it does drive the price up. That doesn't mean the gold comes off of COMEX. It's the participants of the COMEX battling each other. Okay, so we're not at the point of force majeure yet, because we still have ample supplies of both gold and silver in registered category, and maybe some could also come from eligible that's not pledged for other uses. And we got, right now 128 million ounces of silver. That's pretty healthy. A little bit came off 242, not a whole lot. And some came out eligible, but not a whole lot. It's not, we're talking very small percentages. So until we see the COMEX actually get drained and people take it out of the COMEX and say, I don't even want it on the COMEX, that's when they could declare potentially a force majeure. So we're not anywhere near there yet. It's really the big boys battling each other. This is not a retail market. This is not us buying gold or silver from various retail markets. These are the big futures contracts from the big boys, the bullion banks, the sovereign players like the nation states, the manufacturers, the miners, and those guys. Basically, they use these markets. So it's not the individuals. I just wanted to clear that up because there are some questions about that. So we're nowhere near force majeure right now. We would have to continue to see a lot of standing for delivery for that to occur, and I don't think we're there yet. But in any case, just last minute, going back to gold and silver so we can wrap up this video. It's been quite long. I don't see gold doing the cup and handle right now back to 1655 based upon the positive amount of standing for delivery the longs have. They've captured that market in this gold volume. I think December will tell us whether gold's going to pull back and make a sharp move into a cup and handle position or go forward. Until then, I think it'll range trade somewhere around here. Now it got frothy about above its all-time high, and now it's starting to retest. As you can see, if gold pulls back 1900 again, it's just retesting that previous high in 2011. That's okay. It's normal. And if it goes through a little bit, but then bounces back up, we know we're still in that bull market. And that may take a while because, again, the open interest is strongest in the December contract. So it'll take a couple of months. Silver's different. Silver has rocketed up so quick, and we have this big decision month coming up next month in September that I feel as though we're going to know much more quickly in silver whether we continue the bull market or come back down to this range trading level around 14 to 20 bucks that we've been in basically for about 4.5 years or so. Well, actually almost 6 years, dating back to late 2013. So we'll see what happens in silver. We're going to see what happens in silver first, and then we'll see what happens in gold. Will silver's move predict what happens in gold? It's very likely if it's that monetary demand. It's that monetary demand that's driving up silver right here. If we see silver crash through previous resistance levels, okay, look, that means we're going to continue to have monetary demand for both metals. Gold's going to go up. If we see silver crash back down and stay down for a couple of months until December, where we're going to decide what's happening to gold, maybe that monetary demand has cooled off. And we'll know that by the open interest reports on a daily basis and on a monthly contractual basis. So we're going to continue to track that for you in these videos, and we'll continue to provide you more information. Again, stay tuned for Sunday when I add a little bit more detail to the volume charts and we get a little bit more into these spreadsheets on what this means on COMEX. I'll provide a little bit more depth there, and maybe we can kind of see longer term trends there that'll give us a clue as to what we may think will happen in September or December. So please stay tuned for that. I'll continue to build on this series as we go along. A little bit of housekeeping again. People are asking me in the comments, do I understand the fundamentals? In other words, why are people getting into gold and silver in the first place? While we're looking at all this transactional data on a month-by-month basis, these are the decisions that traders are making in the futures markets. They don't make those in a vacuum. They make that based upon economic decisions and industrial decisions. Gold and silver are both industrial metals. Silver much more than gold, but gold is used in electronics and for other things. Jewelry, for example, much more, a higher percentage of silver is used in industry, so it has a higher industrial component. Those factors and how the economy is doing is going to affect the industrial components of each metal, which will be different because silver is more industrial now than gold is as a percentage of overall percentage mined that's used in those purposes. But there is also an investment demand that's coming into the market, which is causing these metals to rise. And that's typical. When investment demand comes in as a safe haven asset, fleeing other assets, due to low interest rates or uncertainty in the economy with the stocks and stuff like that, it'll flow into the metals. And that's the other component. And that's what we're looking for here. And when we're talking about monetary demand, we need to look at economic fundamentals. So I'm going to start an economic fundamentals series as well, which is going to look at those fundamentals, and that will give us a longer term view on these metals than just these trading charts do, and maybe give us a better idea of where these are going over the next several months to 6 months to a year. Okay, instead of just looking at sort of the day-to-day, month-to-month type of stuff. So I'll continue looking day-to-day, month-to-month, because we're in this big bull market, but we're going to expand it out with some additional fundamental talk to give us a bigger view of what's going on in gold and silver. And that's really going to give us the long-term picture of where we are. And that'll get to my roots as a cycle trader. I look at cycles, and the reason I'm in gold and silver is because of this multi-year cycle. And that comes from fundamentals. So we'll get more into that as we go forward. All right, I'm going to stop sharing now. That's the report for this Thursday. Hope you guys enjoy it. I will come back probably with Sunday again with some additional information and some market knowledge and prepare you for the week of what we think we're going to see next week as we continue to march on in this gold and silver bull market. Thank you guys very much for participating. Love to see your comments below. Please leave those for me. If you guys are getting into this for the first time, go back to my July 14th video where I predicted silver would pop. It did 4 days later, where I began teaching about how these markets work. Do that before Sunday, get caught up on the series, and then by the time we get to Sunday, you'll be caught up and you understand a little bit how this works, and you'll be able to absorb that additional information I'm going to give you on Sunday. That's critical if you're new to this series of videos. And if you're new, ask questions below, because I like to come in and answer questions, and it also gives me an idea of what my audience is like and what information they need. So I value that feedback. Please give it to me. Okay, until next time, guys, this is Rob Keens of goldsilverpros.com.